Alright guys, welcome to the class with the accounting guru, as we are doing question 2, which is income statement, right? So yes, which is 45 marks for 35 minutes, but I will take longer. The reasons because explaining and not just writing for myself, I need to make sure that you guys understand. You are my priority. So yes, that's what is gonna happen today. So they are saying the information is from Books of Andrews Traders, right? The financial year ends on 28 February 2018. So it is very important. I always tell you this. You must know when your financial year ends and when your financial year starts, plus 1 month, which will be 1 March, minus 1 year, 2018 minus 1 year, 2017. This is how you always do it, guys. So now our focus is on this part here, and then under nominal account section, right? Also under the balance sheet section, we are going to consider trading stock and loan when we are preparing our and also fixed deposit. Yeah, so also provision for bad debt if it is there. So I told you guys this credit side means income, right? The debit side is for the expenses. So it is very crucial to know this. So now let's do our things. As you can see, they recorded what sales for us, cost of sales. So let's go to the adjustment. We have adjustment A. They are saying no entry was made for credit note, right? And I told you this credit note there, then issued to debtor. It's us, the business, issuing a document to a debtor, and that document, it specifies something. I'm not gonna say it, guys, because I told you. Yeah, I told you this. For stock returned, right? For 3,000. This is the selling price of the stock. This is the cost price of the stock. So I need to ask you a question, Bali. What is a credit note? What did Prof taught you about credit note? What is credit note? You are correct, but you are not specific. Be specific, my guru. Okay, repeat what you said there.
A credit note is a document that is issued to a seller. For example, when
To a
we have
seller, issued
damaged
to a
goods
seller, issued to a
or
seller.
we
Wait, issued to a seller or a customer?
a seller.
A seller. Who issue it? Who issued the debit note?
Is it not the customer, sir?
No. So a credit note is a document issued to a customer by the business that indicates a reduction in the amount they owe us, meaning that a credit note is a document issued to a debtor that indicates what a reduction in the amount they owe us. Is typically used in the following situation, like returns. As you can see that K. Lebona returned. So when K. Lebona returned goods, we issue a credit note to what? To the debtor. So returns, discounts, errors, you see. So when a credit note is issued, you must know that we must minus what? We must decrease our sale. So we are going to decrease our sale with a selling price of what? 3,000. That's why I always tell you that from those formulas I gave you, saying credit note, the selling price of credit note reduces what? The sales. So you understand it now, right? So we know that when they are saying that cost of goods returned. So this is a cost price, and this cost price is going to be recorded where? In the cost of what? Cost of sales. We are going to minus what? 2000. Yeah. And you should always know that it is very much possible that we are not done with this part of sales. It is very much possible that they can ask you this, they can give you cost price of the returned goods and the markup, which you should calculate the selling price of that credit note. So let's minus what? Debtors allowance. Debtors allowance reduces the sales. We know here it is given, which is 12,400. 12,400. Dango. So now let's put in a calculator and see. So let's get our answers for sales 128. So the answer for this actually it will be 1,264,600. Then our answer for cost of sales, it will be, we must put it in a bracket, it will be 638,000. Then the difference, you know that sales minus cost of sales, so we should get what? Gross profit. We're going to get gross profit of this 626,600. So this is how it is. So now we go to transaction B. They are saying that on the last day of the financial year, this at the end of the year, a physical stock revealed the following: trading stock, stationery. So let's take our stationery. We have to minus the stationery there. Let's go to the stationery. When we minus stationery, remember that we need what? We need used. This is on hand. So the one from the trial minus the on hand, it means that we are going to get used. So sometimes they can just write trading stock used or stationery used. You just record it directly. So 1,400. So let's see what are we going to get there. 23,200 minus 1,400. We're going to get 21,800. Yes. So now trading stock, right? Let's write our trading stock. So let's check whether the trading stock is a deficit or it's a surplus. So let's check the trading stock. Remember, we compare. We can have an income, we can have an expense. So we call it a deficit or a surplus. So let's check the trading stock from our trial balance. So what? When you check the trading stock, it's 123,400. This is what we are saying we have, and we realize that we have less than what we were expecting. So this is a loss. So we are going to record it under expenses, right? Operating expenses. We are going to write trading stock deficit. Deficit. So we open our bracket. After opening our bracket, we are going to take the one from the trial, which is 123,400 plus that cost of retained goods, right? We received the returned goods. So this is the cost. So it's like when you had goods, maybe 5,000 goods, then you sold maybe last year 10. When someone returned that goods back, it will increase your stock. So we are going to say minus what? Minus this one. We're going to say minus 119,000. 119,000. So how much are we going to get if we put this in a calculator? 123 400 plus 2000 minus 119,000. We are going to get 6,400. So now we are done with trading stock. So let's go and stationary. So we cancel this one. We are done with this. So we go to transaction C. They are saying that a debt R when a world who owes 800 must be written off as irrecoverable. So when you write someone off as irrecoverable, this is bad debts. Bad debts. So you come to your bad debts, you add what? 800. Yeah. So let's see what are we going to get there. 11,300 plus 800. We're going to get 12,100. So we are done with this transaction here. We go to transaction D. A telephone account for February 2018 has been received but not yet paid. Right? So this is a accrued expense. So they are saying that a telephone account for February, which is at the end of the year, has been received but not yet paid. So what is going to happen? This is, remember I gave you a strategy. I said under incomes. I said when they owe you, the expenses also. So when you owe, let me do this in simplest way. I need to put this in my study guide, the strategy, and I found a way to make it easy. So owe, then I will say owing. So under incomes, when owe, we owe them. When we owe, it's a minus. This side, when they owe, when we owe, it's a plus. This is a plus, this is a minus. So now this telephone is an expense and we need to pay the telephone account, but has not yet paid, meaning that we are owing. So when we are owing, under what? When we owe them. So let's say owe them. When we owe them, we are going to increase what? The telephone account with what? With 2,200. Okay. So let's see what are we going to get there. 23,200. No, it's not. It's 70,500 plus 2,200. We're going to get 19,700. Thank you. We are done with this part, telephone account. So you must know that in the balance sheet, let's just do this. Just do this. Yes. What is happening now? Yes. Slow. Okay, it's fine. I wanted to do balance sheets also. So now we have adjustment. They are saying an annual insurance. This is for 12 months. Premium of 7,200 was paid up to 30 September 2017. So this is insurance, right? So was paid until September 2017. And when we check that, was paid on, okay, meaning that it was started on what? On September. So when we check our financial year, remember our financial year starts on 1 March 2017 and end on 28 February. So meaning that This insurance, they are saying it's an annual, meaning that it was paid. This 7,200 covers from 1 March 2017 to 28 February 2018. But when you check there, they are saying that it was paid on 30 September. So this 1 March 2017. This is 28 Feb 2018. So this is timeline. After March, we have April, May, June, July, August, September, October, November, December, January. So check here. When you check, it was started to be paid on 30 September. This is September. Started here. And they are saying it's an annual, means that 12 months. So this insurance was supposed to cover from September until 28 February, which is how many months there? When you check September, October, November, December, January, February, 1, 2, 3, 4, 5, 6. It was supposed to be paid for 6 months, but that 7,200, it's for what? It's for 12 months. So we paid extra months that we were not supposed to pay. So what we are going to do here, we are going to use UK method. You know that I taught you UK method. Or we just do this 7,200 divided by 12. We know that this is for 12 months, as they said, annual. So how much are we going to get? Let's check. 7,200 divided by 12. We are going to get 600. 600 times 6. Let's see what are we going to get. Times 6. We are going to get 3,600. Right? We are going to get 3,600. Is it? 3,600. Let's confirm. Since it was started to be paid on September, right? Where is insurance there? Annual premium, right, was paid on 30 September. Okay, 30 September 2017. So this September, October, November, December, January, February. 1, 2, 3, 4, 5, 6. 7,200 times 5 by 12. Okay. I'm so sorry, guys. I made a mistake. There. So this is what is going to happen. We know that the 7,200 is for 12 months, and we paid how many months that we are not supposed to pay from 1 March? 1, 2, 3, 4, 5, 6, right? 7, right? The reason why I'm saying 7, from March to September. So this is the end of September. So the insurance won't count on September. It will count on what? October. So from October to Feb, it's 5 months, right? So now, when you count from March to September, how many months are there? 1, 2, 3, 4, 5, 6, 7. 7 months that we paid, right? This is prepaid expense. So 7,200 divided by 12, we are going to get 600. Times 7, we are going to get 4,200. So let's use UK method. 7,200 times what we want. We want 7 months. Divide by what we have. We have 12 months. So let's see how much are we going to get there. 7,200 times 7 divided by 12. We get 4,200. So they are owing us according to the principle. In the expenses, when they owe us, we do what? We minus again. So minus 4,200. So how much are we going to get? So minus 44,400. So this is 39,800. So this is prepaid expense. The 4,200. We should record it under your. This is prepaid expense under your debtors, under your trade and other receivables. So it doesn't want to appear. I was going to record it there. So now I hope you are writing notes, because that's your homework to go and redo the question 3. So now we go to bank charges, right? Let's check. We are done with this adjustment. Let's go to,
Is that which one is homework?
this is prepaid expense, the 4,200, and prepaid expense is recorded in your trade and other receivables. So now the bank charges received on 28 February 2018. We received bank charges. We received a bank statement on the end of the year, the last month, which is 400 bank charges, as they are saying there. We need to add, remember, that's what I always tell you, plus 400. Then what are they saying? A check, meaning we are going to say EFT, we are no longer using check. An EFT of 13,000 from a debtor, J. Taylor, dishonored due to insufficient funds. So meaning when they are saying dishonored EFT or dishonored check, meaning that you were trying to pay me 200 while you are owing me 5,000. Or maybe you don't have that sufficient fund. You don't have 200, but you are trying to pay me that 200. Because the moment you wanted to scam me, actually, I get it will show like you paid, but it will bounce back. So this is what we call dishonored check or EFT. So when you see this, will assist you when you are doing your reconciliations. So now when you see this, this transaction, it does not, I don't think it affects what it affects our, it doesn't affect our it doesn't affect our income statement, né? So let's check the last one. They are saying a p bill, then what a debtor whose account was previously written off as irrecoverable deposited 900. This is what we call bad debts recovered. So we are going to record bad debts recovered, right? Bad debts recovered, bad debts recovered as 900. So thank you. So now we are done with this transaction G. So they are saying provide for depreciation for the year. So they gave us depreciation there. So let's check discount allowed. Let's check the other transactions there. Number F, we are talking about a fixed deposit was invested on 1 March 2017 at the Absa Bank. The interest was received for 9 months old. Provide the outstanding interest. So this means that they are owing us actually. They are owing us. We should record it under this. So this depreciation. Where is depreciation? Where is depreciation? So depreciation. So we have to get the outstanding. What? The outstanding. So let's record our salaries and wages. We'll come back to it. Also rent will come back to it. So yes. So let's do this. Depreciation for the year. So is there any adjustment for depreciation? Let's check. Nope. We are going to record that one. 47,500. So now they are saying done with this adjustment K. An employee has been omitted, meaning they forgot, right, from the salaries journal of February 2018. His details are as follows. So now we need what? They gave us what? Contributions, right? They gave us net salary. They gave us deductions. And I taught you something. If you remember, if you guys always study your books, you will remember this. I said that we need what? We need gross salary. That's what we are going to record in our salaries and wages. Also contributions, unless they provided a separate account which is written employees contributions, right? Employers contribution, employees contribution. Okay, so now we know that to get gross salary, we know that gross salary, as I told you the formula, it's what? It is net salary plus deductions. You know that. So already you know when you add the two, you're going to get what? You're going to get what? You're going to get your gross salary. So 13,000 of net salary plus 6,000, you're going to get 19,000. So 19,000 is your gross. Come and record it here. Plus 19,000. Alright. And what? You need to record what? Deductions. Contributions. Plus what? Plus contributions. You say plus 3,000. That's it. Simple. So let's add everything. Plus 184 000 plus 3,000. We are going to get this 206,000 here. So we are done. Now we go to what? Go to the other one. So we are done with this part here. So let's check discount allowed. What are they saying about discount allowed? So let's check. I think there's a transaction we need to check. Discount allowed. Let's check if we didn't skip any transaction. Okay. A spare office rented, no? The long-term loan repaid annually. So wait, I don't see any. Let's check the markup. If we have any percentage of markup there. They didn't say anything. Okay, you guys must keep an eye for me if there's any transaction, because they can't open this for us, and it happens that there's no transaction. Okay, let's do our rent. They are saying that a spare office has been rented out since 1 March 2017, meaning the beginning of the year. The tenant paid March 2018 rent in advance. So meaning that the rent was paid for 13 months. This is what is happening, because from 1 March 2017 to the end of the year, 1 March is the beginning, until the end of the year. Until the end of the year is 12 months. But as you can hear that they are saying the rent was paid, the tenant paid the rent for March, which is income received in advance. This is deferred income. So we received the rent for 13 months. If you check, instead of 12, whatever we receive for 13 months, meaning that we must give it back, that extra month we are owing. So automatically rent is under income, so you know that. So rent income, so you're going to minus. When you are owing, you minus. So let's calculate according to the formula that I gave you. You do what? You check. Okay, they are saying that note, the rent was increased by what? By 1,800 per month from 1 January 2018. So this is 1 January. This is where the increase started. So when you check, increase was the increase of how many months? From January until to March. How many months are there? January, February, March is 3 months, right? January, February, March is the increase of 3 months. So now we are going to use the formula, because the formula says what? The formula says you need what? You need to do what? You are going to calculate what? You are going to check your months before increase again. Your months before increase. So months before increase is from March, because we had that increased on what? January. So it's from March until December. How many months are there? 1, 2, 3, 4, 5, 6, 7, 8, 9, 10. This is 10. You're going to multiply by that increment. How much is the increment? The increment is 1,800. So how much are you going to get when you multiply this? 1,800 multiplied by 10. You're going to get 18,000. This is the rent before increase. So now let's do this. This is after increase. Let's do this. The formula says you take your trial rent, right? The one from the trial, which is this one. So you are going to take it, which is 154,900. Add this one you've just calculated plus 18,000. Then says what? You divide by the total number of months. What is the total number of months? It's not 12, it's 13 because we received rent for what? For March. It's 13 months. So this is how you will do it. Easiest way. So plus 154,900. Going to get this. So let me record this. It's 172,900. So we divide by 13 months. Divide by 13. You are going to get 13,300. So I love this way. I didn't calculate the increase and minus the increase. I know this one will take us long. I just love this short way. So we are going to minus that 13,000 and 300. So this is deferred income received in advance. So this one, it's recorded in your balance sheet where in your trade and other payables. So you must know that when you are doing your homework. So minus what? 154,900. You get this. So let's add everything here to get our operating income. 3,100 plus 141,600 plus 900. I'm going to get 145,600. So you add the two. When you add the two, you're going to get your gross operating income plus 62,600. You're going to get your gross. This is what you're going to get. Again, so you know that your operating expense must be minus an expense, so you put in bracket, show that an outflow of what? Outflow of cash. And here, so thank you. So now we're done with rent and here. So okay, I think I'm aware what is going on. Check shop. Okay, an EFT received from a debtor. All right. So this transaction affect our income statement. An EFT received from a debtor. We received 1,300 from debtor J. Taylor, dishonored due to insufficient fund. The check was received in settlement of what? The person was settling this was in settlement of this, but one wanted to pay this. So it's like the difference of this two, 1,600 minus 1,300 equals to 300. So it's like when I'm selling something for 800 and you end up buying it for 500, I gave you a discount. So the person ended up buying for 1,300 instead of this. So we have a discount, what? Discount allowed that we gave to a person. Remember I told you we have what? So discount allowed, you are going to minus it. Remember when I was telling you we have what we call discount allowed and discount received. So when we give a discount to our debtor, we call it discount allowed. When we receive it, discount received. So 3,800 minus 300, get 3,500. And here and go. So now we are left bank charges 2,300 plus 400, 2,700. And here, so let's add everything there and see our operating expense, what we are going to get. So when you add everything there, you are going to get this 42,900. That's what you're going to do. So according to the principle, we need to minus the gross operating income minus operating expenses to get the operating profit. This is what you're going to do. 772200 minus 424900. So we are going to get this 47300. Voila. So now we need to calculate what. Here we are going to have what you call profit interest expenses, which is loan. So now let's check. We have a transaction for loan. They are saying a long-term loan is repaid annually, so 12 months, on 1 September with an installment of 3,000. This amount has been properly recorded, provide for interest owing 14% per annum. Okay, let's proceed. This is transaction F. They are saying a fixed deposit was invested on 1 March 2017 at Absa Bank. Interest was received for 9 months only, provided outstanding. So I told you, I gave you the formula. You guys, you are so disappointing. I gave you the formula that when you are calculating your outstanding interest on fixed deposit, you should use at. Don't mind this, whatever they are giving you, the dates and months, whatever. I told you, you should just use at method. At means that amount times rate times time. So our amount there that we are going to use, it's 80,000. They are saying per annum 7 months. So avoid those months that they gave you from the transaction. You are going to say 80,000 times what? 7% times what is the time? 12 over 12. So we are going to get what when you put this in a calculator? 80,000 times 7 divided by 100, which will give you 5,600. So 5,600, this is what you are supposed to get. So you just take it and go and record it exactly at 5,600. This is what you are supposed to get. So now the difference between these two, it is going to give you an outstanding. It is going to give you what? It is going to give you it is going to give you an outstanding interest. So now we know that 5,600 minus 4,200. Let's see what are we going to get there. Minus 4,200. We are going to get 1,400. Just say plus 1,400. This is what, when you add the two, you get this. So always when you are calculating this, they are saying that a fixed you are calculating a fixed deposit interest outstanding. They are saying a fixed deposit was invested. Try to avoid these dates, months. Provide the outstanding. You use at amount, rate, time, because the amount that you are going to take is this one. You are going to take this one for current year. So this one, 80,000 multiplied by 7% times 12 over 12. Then what you are going to get, which is 5,600, you are going to record it straight. This is what it was supposed to be. So to know what was the outstanding, you are going to say what? You are going to say the difference of these two, 5,600 minus 4,200. You're going to get 1,400. That 1,400, that 1,400 it's what we call the outstanding interest, ne? So now this is what you do. So let's check the net profit. Okay, we know that this two, this two gives us what? We know this two gives us what most. Let's add the two. 347,300 plus 5,600. We are going to get this 352,900. Sharp. So now we need to get our interest expense. They are saying that a long-term loan is repaid annual 12 months on 1 September, right? With an installment of 3,000. This amount has been properly recorded, provide the interest owing. So we are owing actually. So let me do this. 30,000 times 14. We are going to get this, but this is not what you are going to use. So as I was saying, all right, so let's do our loan. So at your survival, always where you go. So we need interest on loan. So what you are going to do according to that formula, like that I once gave you. So you're going to take this loan that you have here, this one on the credit side, to multiply by what? As you can see, they said 14% per annum. So just use UK method, 150, not UK at method, right? Times the rate, which is 14% over 100, times what? Times 12 over 12. Let's see what are we going to get. 150 times 14%. You're going to get 21,000. So this is the interest that you are going to record, the interest expense that you are going to record here, 21,000. But the transaction still continues. As you can see there, they are saying that a long-term loan repaid for 12 months. So this 30,000 is for 12 months. On 1 September, this is 2017. On 1 September, with an installment of 30,000, this amount has been properly recorded, provide the interest owing. So we want the interest of this 30,000, right? They said 14%. So from 1 September, right, 2017 to until the month end. So when is the month end? The year end, this, right? Our year end on 28th February. So this is September, right? From September, how many months are there until Feb? So September, October, November, December, January, February. 1, 2, 3, 4, 5, 6. This is 6 months. Ne? So we are going to use at. So this is 30,000 times 14% over 100 times 6 over 12. So what? See what are we going to get? 30,000 times 14 over 100 times 6 divided by 12. We are going to get 2,100. So this is the interest that we need for this, the interest owed. We are owed. So we are owing this interest, which is 2,100. We need to increase it. So how much are we going to get there? The total, let's check the total. So plus 21,000. We're going to get 23. So this must be the bracket, or it's an expense. 23,100. So the difference between these two get our net profit. 352,900. We are done. 3, 2, 9, and 800. So your homework is question 3. This is the end of the session. I believe you enjoyed the class. Counting as enough marks for everyone to pass. Aim for the moon. If you don't reach the moon, you fall higher and be Maxwell accounting goal. So sharp.